Welcome and thank you for joining us. I'm Ben Thornley, a managing partner at Tideline. It's my great pleasure to launch the Compass series of conversations with leaders in impact investing. Please do visit tideline.com, relaunch tideline.com to learn more about the firm and our work. For this inaugural Compass series panel, our topic is impact classification, by which we mean a precise, universally understood description of what exactly an investor is doing to create impact. I'll be moderating today's session together with Cathy Clark, a longtime collaborator and one of the leading academics in impact investing from Duke University. 5 years ago, Cathy and I coined the term impact classes. We discovered that without robust classification, the lack of common terms and understanding was leading to inefficiency, confusion, and hesitation from investors. Classification is not rocket science. There are many more complex challenges in sustainable investing, like the efforts we read about daily to harmonize impact data. This is simply about clarifying what each investment is doing and what to call it, so that investors can be properly matched for the needs that they have to the right products that are available to meet those needs. Whereas 5 years ago, we didn't have the benefit of common terms and frameworks, we do now, and we're excited in this panel to share with you some of the developments that Cathy and I believe will make classification a focal point in impact investing in 2021. Before I turn over to Cathy for some additional context, I'm thrilled to introduce our guests: Claudia Coppenolle from the Impact Classification System, Anna Snider from Bank of America, and Bhavika Vyas from StepStone Group. Claudia has created one of the first freely available and easy to use tools for classifying impact investing. Bank of America is one of the largest wealth management platforms in the world with over $2 trillion of assets. Anna is in the Chief Investment Office, where she supports investment diligence and together with Jackie Vanderbrug leads B of A's important work in sustainable and impact investing. Bhavika co-leads StepStone Group's responsible and impact investing practice. StepStone's a leading allocator with over $310 billion of assets under advisement and management across private equity, private debt, real estate, and infrastructure and real assets. So to get us started, I'm going to ask Cathy to provide a little more color on classification.
Thanks so much, Ben. I'm delighted to welcome everyone. Looking through the participant list, I see a lot of familiar names, so I know I'm in a room with friends and new friends from all over. So thanks for that. I think what I wanted to start with is just a little bit of an overview of the idea of what the A, B, and C system of classification is. And talk a little bit more about how it's evolving and how it relates to things that investors are doing every day. And then we're going to turn over to the panel to start to talk about how is this actually working and how can this practice become even more useful to more in the field. So if you could throw up the ABC slide. So many people have probably become familiar with the ABC designation that came out of the Impact Management Project's consensus process over the past few years. We developed this graphic in close consultation with the IMP to make a little bit more clear for people how the classification system works. So I just wanted to walk through this for a minute, which is to say, as you look at any impact investment, you can classify the kind of outcome that investment is targeting by A, B, or C, or if you don't know, it can be does or may cause harm, right? So that's kind of your default if you haven't classified. An A classification is for an outcome for which an asset or an enterprise was performing below what we think of as a good enough threshold and is now actively working to reduce that negative impact. And that can be hugely significant for a very large company or a very large investment. A B classification is for an outcome that is achieving some sort of benefit for stakeholders that is above that threshold. So we think of as positive. And then the C classification is used for an outcome that is basically moving something from causing harm to creating significant and tangible benefit for stakeholders. And that can be deep benefit for few or a shallow benefit for many. And so this is the very simple concept of, it's not about where you are, it's about where you're moving. Are you moving to reduce harm? Are you moving to make sure that you're staying positive? Or are you actually driving a negative to a positive, which is the contribution? And there's some on the slide, it talks about SDG outcomes. That's because we at Case I3 at Duke right now are working in close collaboration with the UN Development Program, as well as the Impact Management Project, to create a training, an online training to help investors and enterprises work to figure out how to manage, assess, and report on their impacts. And what we have found is that once you classify the outcome that you're trying to achieve, you can then manage and assess and report on that impact differently depending on the classification. And so it's a simplifier. So I think I'll leave it there and hand it back to Ben so we can start to talk about how people are using this in practice.
Well, thanks so much, Cathy. And we're going to begin with a quick question for each of our panelists to help set the stage. And Anna, I'm going to come to you first. And we'll come to Bank of America's new taxonomy in a second and dive deeper into that. But to get us started, Anna, can you tell us what classification means at Bank of America and why that's important for you in your work?
Sure. So to make things easy, we're actually using the A, B, and C framework, and we've evolved that a little bit for sort of what we see in the market, which we can talk about, as you said, in a bit. But for us, the ABC framework, which is what we're using as the basis for classification, like Cathy said, it allows for a clear differentiation across sustainability objectives or outcomes or impact. And it also allows us to sort of see, what the level of integration and outcome and impact is, and to start setting up a way to measure it. I think as we were thinking about whether to pursue just for our own, benefit and for our clients, so a lot of the work that we do is very centered around clients. And what's going to be most simple and sort of resonate with them to understand, to be able to begin adopting sustainable or impact approaches in their portfolio, right? And so for us, we thought that the classification system, we leaned toward that because we thought that it reduced some of the black box methodology and approaches that come with a fund rating or ranking system, especially because the way we see the universe is that actually there have become a lot of different types of sustainability approaches with different measures and different ways to implement. And it's hard to capture all of that in a fund rating or ranking, at least for us. I think others on the panel probably have been more inventive than we have actually in that regard. But we decided to use ABC just because something simplistic doesn't mean that it's not thoroughly researched, and we thought that the Impact Management Project did a good job in doing that. So
great. Well, thanks, Anna.
Yep.
Bhavika, turning to you. There's been some exciting developments at StepStone with the launch of an impact investing platform, which you helped to lead. StepStone already had a very active responsible investment team and set of tools and frameworks. How's impact different to what StepStone was already doing in responsible investment?
Yeah, no, thanks, Ben. As you mentioned, so we've been integrating responsible investing into our processes for a long time, and it's part of everything we do now since we signed on to the UNPRI in 2013. Impact is a little bit different because RI is so integrated into our process. We also had a number of clients come to us who wanted to target specific themes or specific SDGs, as Cathy mentioned. And so for us, impact was really to create a bit more focused portfolio. So on top, leveraging the RI platform that we've already built, we've created, and I think we'll talk about later, we have an RI scorecard that we use to score managers on an RI basis. We've created a parallel impact scorecard which actually builds on a lot of what Cathy and Anna talked about in the ABC framework. Similarly, we've created a thematic taxonomy that is very similar actually to the ABC in concept, and looks at a number of different sub-themes so that we can align clients' portfolios with the SDG goals that they're looking to have.
Great. Well, thanks, Bhavika and Claudia. The impact classification brings to life some of the frameworks that Anna's just discussed and Cathy introduced to us. How are investors using the framework and why are they using the framework?
Yeah, so the main users of the ICS platform, as you say, are investment practitioners. So on the one hand, we have the asset managers, on the other side, the asset owners, and they really use the system and the digital process to get a better understanding on how investment products meet their impact goal. And they do that by looking at the underlying classifications of the funds. Since our beta launch in June, we have approximately 150 accounts live. The majority of those are accounts from asset managers who use the process to classify their funds and then share that information in form of classification statements on a public directory, as well as with their LPs and with potential investors. The use cases for asset owners is slightly different. So we have seen an uptake in usage for portfolio construction, so initial screening and onboarding of funds. So it's strictly the asset owner who requests classification from fund managers, but they're also using it for their portfolio management and the strengthening of their internal kind of reporting capabilities. I think given that we're one of the few free digital impact measurement and management tools out there, we have actually also seen an uptake from various ecosystem players who use the system to either educate themselves on existing best practices and the classification process itself, but also obviously leverage the classification information we are collecting through the system.
Right. Well, thank you, Claudia. Anna, we'd like to dive a little more deeply into the framework that Bank of America has put in place. Could you, we'll share that slide now. Can you tell us a little bit more about it and how it was created and how you use the framework?
Sure. This classification framework, again, as you see across the top, the ABC, and I'll talk about the 1, 2, 3 or the y-axis in a second, but we really created it to help internally. So I run the manager selection or due diligence team at the firm, and we created it to really sort of start distinguishing actually sort of which strategies were actually sustainable versus those strategies that are not. So it's used only to classify strategies that we're trying to ascertain actually whether they are sustainable to begin with, or can be called, even outcome or impact oriented strategies. So that was one. But what we've tried to do is also match this to how we believe that clients come at sustainable investing in general, right? So there's sort of one of two ways that we've seen them come at sustainable investing. This framework sort of captures those client motivations that sort of center around saying, I don't exactly know, which issue areas I really want to dig into, but I just want my portfolio to reflect companies that are acting responsibly, right? Or I'd rather steer away from X, Y, and Z type of companies because I actually think that they pose forward-looking investment risks in my portfolio. So that's why I'm interested in sustainable investing. Or, obviously I want to, on the contribute side, I want my money to make a positive impact. And here's sort of how I'm thinking I want to do that. This classification framework, similar to what Bhavika just was talking about, I think is actually accompanied, and it's not here, by another more thematic framework where someone who's looking at either A, B, and C strategies can sort of do another layer of pinpointing what environmental or social or governance oriented investment issues or issue areas they're interested in, And we've created that based on the IBC framework that the World Economic Forum put out, and there are sort of 4 thematic pillars that sort of relate to the SDGs. I won't spend a lot of time on that here, but it really, this framework basically, if you triangulate those 2 things, you sort of capture the ways that at least our clients at least start talking about, and even more sophisticated clients evolve their thinking around what kind of investment strategies they really want to invest in. We also think that this really helps with, as Cathy said, a lot of times these strategies are moving towards something. So really sort of looking at not only the sustainability objective, but this depth of integration or the depth of intensity of what types of sustainability, either a sustainability profile or certain KPI metrics or certain impacts or outcomes that they want to accomplish. This helps us really almost bucket managers in a way that we can both compare them, but more importantly, for each individual strategy, it allows us to really define what, along with the manager, generally speaking, what measures we're going to monitor them on going forward. And there are different sort of measurement and quantitative, KPI/metric requirements that sort of put you as a strategy into one of these buckets relative to the depth of integration. So that's really sort of how we approach this creation of this framework.
How difficult has it been, Anna, to classify the funds in your universe on the basis of the framework?
Well, I mean, when we first started classifying the strategies, I think there were, we had to make some decisions. I mean, certainly many strategies, both in the public and in the private markets realm, use a combination of avoid or benefit or, potentially contribute approaches. So certainly while there are some strategies that are, sort of pure impact plays, a lot of the more public strategies we see are actually, they start with, deciding what they're not going to invest in and then start deciding what they are going to invest in, right? So there's a combination of A and B, and then some are also doing sort of slivers of, sort of contribute types of, investing in solutions-based companies or other things like green bonds or other, projects that are financing, true sort of impact or outcome type of project. So, we did debate as to sort of what thresholds you had to hit that would, move you from an A to a B to a C. But in general, it was not, it's been relatively easy. Once we've sort of established what our approach was, the only thing that doesn't fit neatly into this framework are strategies that really only seek to use engagement as sort of the only tool. And we felt that, certainly while engagement, and we have a lot of academic and other industry colleagues that have put out amazing work on the value of engagement. But for us, it was hard, we see engagement as a tool in addition to pursuing a sustainability objective in a portfolio, rather than, an objective in and of itself, right? Because engagement it's hard to measure because it requires generally more than one shareholder is controlling the outcome of that engagement. It's a very long time period, et cetera, et cetera. So without even just, if you strip out all of what I just said on sort of the more complexities around engagement, we just felt that it is a tool that's used above and beyond either avoid or benefit or even contribute strategies. And actually we do normally see strategies that hold themselves out as really pursuing engagement as their major objective, also integrating at least either values-based or materiality-based avoid, quote unquote, strategies. So that's been some of the, but otherwise it's actually pretty darn simple, which is why we selected it, as I said, in the first place.
That's great. Just a couple more questions, Anna. One about the managers you're classifying. Do you share the classification with them, and how have they received the fact that you're putting them into these categories?
Yeah, we do now share it. I mean, we rolled it out this year, so we're still in somewhat of the early stages, but we do share the classifications with managers. We often get and the reason is because we're engaging with them before we actually include them on the platform, generally speaking, and actually while in the monitoring process that we're doing with them, we're engaging them around actually how they're defining their sustainability objective, because it's one of the conversations that we need to understand and in order to actually classify them according to this framework. So, I think, we have gotten some pushback, I think, really around the depth of integration, so that everyone sort of understands whether they're in the A, B, or C, bucket. But it's really when we're sort of classifying them along the lines of integration. My observation is that, in particular, I think in public markets, but also I've seen in private markets, where you've seen prospectuses, start including the ability for ESG to be used as part of the investment process. And you're starting to see lots of managers talk about the fact that they've integrated ESG for the last 400 years in their investment practices. I think the word integration has become a little bit, it's actually become less defined and more widely interpretable and used by asset managers that we see in both the public and the private markets. And so really digging in on what actually integrating something into an investment process looks like, and what are the outcomes, or what are you trying to do when you're doing this, has been somewhat of a difficult conversation with managers, but we feel that that's sort of the rigor we need to, or at least a standard that we need to keep, for ourselves. So.
Right. Well, thank you for sharing the framework with us, Anna. We appreciate it. Bhavika, turning to StepStone Group. So you mentioned that you've created a new scorecard. What are your aspirations for the way in which the scorecard is used? And you've been using the responsible investment scorecard for a while, so we'd love to hear a little bit about your aspirations for that process.
Sure, and maybe I'll just give a quick overview of our scorecard. So our impact scorecard, which we worked on with Ben and the team to develop, it mirrors very closely in structure our responsible investing scorecard. So we tried to create 5 fairly distinct factors that our teams could diligence as it comes to a fund or manager. And we use the scorecard really to guide our conversation, both our diligence of the manager and the fund, but also our conversation. I think, as Anna alluded to, that it's an evolving sort of thing. We don't have a minimum score we're looking for. The funds that we look to invest in fall in our classification broadly, while we don't use exactly the ABC framework, in the B and C categories. But we do look for improvement of a manager over time. We do look for engagement with us on these topics. And so I think the scorecard is really useful in driving those conversations. In terms of the 5 factors we look at, the first is impact alignment, which I think is pretty clear, just really looking for how clear are their objectives around social or environmental impact, and are they aligned with any market standards? Accountability, so internal accountability at the manager for those things. Assessment, how do they incorporate it into their diligence? Contribution, so their value add to the investments that they make. And monitoring reporting, which is very, very important for our clients on the impact side, because it's the way that we make sure we're tracking progress. And so for us, the aspiration is that this will become a point of conversation with managers and help us to guide that conversation. We unlike what Anna mentioned, we don't share our scoring with managers or our classification. We know some managers look for the impact classification. We like to be, in our diligence of them, somewhat independent of whether or not they choose to classify themselves as impact, because we've seen some impact washing. But we do share, I think, as Anna alluded to too, that progress that we look to see from them and the specific issue areas in which we want to see progress.
How do you expect, Bhavika, that once you've gone through the process of scoring, hundreds of managers, that'll be a fairly normal distribution across the scorecard? Like, are you confident that there is a sufficient universe of institutional quality managers to get to the top scores in the scorecard?
It's funny because I know, Ben, you and I had this discussion quite a bit. We've tried to be very aspirational with the top end of the scorecard. So to achieve what is a 4 in our 1 to 4 scoring system, it's really what we've seen very few managers do so far, but what we think the space should aspire to. So we do, and as I mentioned, we do incorporate both managers that are in that B category and in the C category for us, which we define as thematic and impact. So we have seen some dispersion across those two types of managers, particularly in areas like monitoring and reporting. And so that's an area that I think we can really engage on to bring those scores up. You know, on the RI side, we actually have seen more of a normal distribution, and where people are very low, we've actually not pursued those funds because we think there's real risk there on the investment side. On the impact side, I think it's still to be seen how the distribution emerges, but we do expect that some more impact branded funds will be somewhat higher on the scoring initially, and others we hope to bring along the scoring spectrum as we work with them.
And similarly, turning to the client side, how do you imagine bringing clients along in that conversation, or how do you imagine the conversation playing out between StepStone and your institutional clients on the impact scorecard and you know, the new impact platform more broadly?
You know, I think as both Cathy and Anna alluded to, there are clients in the market who know exactly what they're trying to do because they have a mandate, let's say from the board, to target climate change solutions or something like that. And then there are others that want to integrate some SDG alignment into their portfolios, but are still somewhat agnostic about where to focus. And so the conversations vary quite a bit. I think what we've tried to do with both the taxonomy and the scorecard is to maintain a consistency of process that's familiar to our clients. So because our impact scorecard looks much like our RI scorecard, it enables us to roll it out across our diligence teams in a way that hopefully will continue to be fairly seamless because it's familiar and the process is very similar. And from a governance perspective, it's the same working groups and investment committee that approves both the responsible investing diligence and the impact diligence. And I think that helps on the client side as well, because clients who are existing clients of ours take comfort in our process, and the impact process is very consistent with that.
Mm-hmm. Well, thanks, Bhavika. That was very helpful. And I'm going to turn it over to Cathy now to continue the conversation with Claudia.
Thanks, Ben. So Claudia, as you are working to create an online system that allows people, specifically funds, to classify themselves, how prepared do you think those funds have been to do that consistently in a standard way?
Yeah, I mean, I think that really depends
your slide
on
as well, if you want. I'm sorry to interrupt you. Just wanted to make sure your slide can go up while you're talking.
So yeah, I think that really strictly depends on what type of manager and fund you're looking at. So if I look at the funds we currently have on the platform, then, you know, on the one hand, you have the early adopters or impact native or impact first funds, and they usually have a very solid understanding and knowledge about the existing best practices and measurement approaches. They also have an initial understanding of impact classes often, and hence I think they felt that the self-classification process was quite intuitive. And they actually, in their own processes, and you have heard that from Anna and Bhavika, applying very similar criteria and measurement approaches. And so filling in the information in a standardized way, if you like, is quite easy for them. And we do have seen consistency in how people have classified. Then on the other end of the scale, obviously, those that are new to the ecosystem and to impact measurement and management more broadly, and unfamiliar with impact classes, for sure, you know, they require a bit more information and guidance, and we have seen inconsistencies in responses, which, however, we think the field as a whole or the system can help to address. So the ICS itself has integral education modules and provides practical guidance and examples to those practitioners that are not familiar with impact classification. And we really hope that that will support anyone who wants to start using classification as a means to assess impact. Secondly, we are obviously offering direct engagement with our team and our extended team at the Impact Management Project through further education, and we're collaborating with amazing people like yourself, Cathy, to help further education in the field. And also we offer opportunities among practitioners and peers for best practice sharing. And then thirdly, we obviously are also very well aware that, and we want to encourage that people make use of external or third-party assurance and verification of classifications. And ultimately, that will obviously also further the standardization of classification. How is it applied among practitioners?
Great, thank you. So can you tell us a little bit about the role of SDGs? We could see from your slide that was up a minute ago, and maybe we could put it back while you answer this, that people are actually classifying in either in large part or completely by goals, by sustainable development goals and outcomes. How does that integrate with your platform, and what does it allow people to do?
Yeah, as the slide shows, and you've explained and pointed out there, so the SDGs are a central element to the ICS platform, as we are not only asking people to express their main impact areas or targeted main impact areas, but also further describe how they're assessing ABC contribution per SDG. So it really provides additional information to investors and asset owners about how they're advancing those global goals. And we've spoken a little bit about improving and moving. It's really also about that. So the reason why we decided on the SDGs, because they also already have proven so very helpful in creating commonality in the way people understand and describe social environmental impacts. And then importantly, the system always aims to align with evolving standards. And I think many of you will be familiar with the UNDP SDG impact standards, and Cathy, you have mentioned them in your introduction. So we are also aiming to further integrate with the SDG and align with the SDG impacts by providing a way that practitioners can actually engage with them through the ICS system. And that is one of the system enhancements that we're adding to the system early Q1. Importantly, for the ones that don't know that, the ABC categorization already is applied as part of the recommended practices in the SDG impact standards. So it's a natural extension of the work we are doing and the work everyone here on the call is doing. Great.
So as you continue to work on the impact classification system platform, Claudia, what is your vision for its adoption and use larger in the field?
Yeah, well, that's a very good question. So maybe in light of today's session title, Cathy, I do think that 2021 has a fair chance to become known as the year of impact classification, hopefully. And if not impact classification, then hopefully at least the year of impact investing more broadly. And thereby we might just be lucky enough or, achieve the widespread adoption of the ICS as part of the wider effort of the field to move towards consistent impact classification. I think ultimately we obviously would love for the ICS to become an integral part in the impact practice of all investment practitioners. But predominantly, I want it to be a tool that makes the life of practitioners easier and helps to accelerate the growth of the field in a credible way.
Fantastic. So we're going to go into a few minutes of Q&A, and we have some questions that have come in. So I'm going to start moderating and feeding them out to different people on the panel. I wanted to actually bring two in because I think it's a very important clarification. There is a question here about, are we talking only about private funds? Are we talking also about public funds? And I'm wondering if each, Anna, Bhavika, and Claudia could each answer that pretty quickly. Is this an overarching strategy for you of classifying, or are you concentrating in one or the other? Anna?
Every asset class, every structure that you can think of, it applies to.
Bhavika?
So for us, we, as Ben mentioned at the outset, we work across 5 different asset classes, but all within private. So for us, our entire classification system is related to private markets.
Great. And Claudia?
Yeah, same as Anna. So the platform caters across asset classes.
Great. And Ben, in terms of your work at Tideline?
Yeah, across asset classes. And I think one of the points that that Cathy, you and I make in our blog, I'd encourage people to take a look at that blog that was published this morning in Impact Alpha, is that more A is great and should be encouraged. And I think just getting managers who are not currently thinking about broader sustainability practices to be more proactive and to actually from not being on the framework to being on the framework is just as important as moving managers toward B and C. So I think that probably the bulk of assets, and on your platform, I'm imagining public markets assets, and the kind of impact they're having is absolutely critical.
So there's several questions here about kind of how does this align with other frameworks, right? So one question is, it seems as if most of the impact investing market as promulgated by the GIN would be in C, and that SRI and ESG would be in A and B. My own take on that, and I would love to hear others, is that in a sense we're trying to blend these a little bit more. So the idea of SRI was, as some of you have talked about, is to not invest in the things that do harm. That's not even an A. That's the does harm, right? So now we're saying, what about the people who are trying to do less harm and trying to do substantially less harm, which is a different concept than negative screening, right? And I feel like the B is even closer. I'd like to think of it as B Corps, right? Where you're trying to say, I'm actually trying to make sure that I am creating a positive benefit, not just for the, that I make up, but that is good for a stakeholder. And so that, when you think about B Corps, they're arranged around stakeholder impacts, right? What do you do for your community? What do you do for your supply chain? What do you do for your workforce, right? Thinking of that as the domain of an outcome that you classify. And then the C has, some more metrics attached to it to show that you're doing more. But I would love to see if anyone else wanted to reply to that. And then the other quick question that people asked about is, how does this relate to the IFC operating standards?
Yeah, I guess I'll just jump in quickly. I mean, I think that I would say 5 years ago, I would have totally agreed that probably C is what GIN's trying to do, and A and B is what like US CIF or PRI is focused on, type of thing. But if we're using networks as a as a way to classify, but I think the world has become in a good way more complex than that, right? That private market strategies, some of them are stopping at investing, looking to invest in B companies. And so it's not an asset class thing, or it's certainly not an industry network thing. But I do think it's an evolution of how you invest, right? So there are many people that the first way they start out with thinking about this is through looking at, say, the SASB framework and thinking about materiality, right? And that is a void, right? It's not, right? And then your next step is to say, okay, I understand the framework in which I'm looking at risk, right? To me, there's almost like a risk to a risk and return blended outcome to an outcome that is a sort of the double line outcome, rather than to try to use either asset classes or industry frameworks to try to get at that. It is a evolution of thinking about, taking risk off the table, right? And then taking risk off the table, and then tilting your allocation towards, right, like you said, Cathy, those companies that benefit, towards then defining certain outcomes or impacts that you want to have an investment strategy, rather than to try to mar it, like I said, with asset classes, because I think that makes it really complex.
Great. We have another question about How do you get stakeholders' responses to the invested companies to ensure the impact is being delivered? And so actually maybe want to invite you, Anna, again, to respond to this idea. When you were talking about integration, right? What occurred to me was, as you were saying, you know, it's less defined. It's you know, the practices of what people actually do to make real the interaction that they have with their stakeholders are in a sense kind of what you're looking at, right? When you're looking at a set of investments, what are you actually doing? Not what you say you're doing, what are you actually doing? Is there any flavor that you can give to some of the stakeholder engagement practices that you like to see or that you've been impressed by?
Yeah, I mean, there are many models where people can engage with companies or get the information from companies they need to claim they're doing integration. So my focus is not generally at like how the sort of the various models that you can have to get to that. It's what you do with the information. And for me, when I'm looking at a, you know, a strategy that has multiple companies or issuers in it, again, regardless of the asset class, I'm actually looking at whether the manager is both intentionally, obviously, or maybe obviously, but also consistently integrating environmental, social, or governance aspects into what they are investing in. So I'm a little less, I don't know if Bhavika has some other insight in terms of how they're doing this in the in the private realm, but I'm a little less. I judge a little less on sort of how they're getting the information, how they're engaging with the companies to get the and what they're actually doing with that information once they get it in-house, I suppose is the right way to say it.
Mm-hmm.
Yeah, I think we would agree with that. I think it's we are less focused on how they engage, but we are focused on sort of what they're measuring, consistent methodology, and making sure they're actually holding themselves to that standard over time to ensure that they have progress. So there's some linkage between their performance or their incentives and ideally and their progress on those metrics.
Great. Ben, can I ask you to talk about the interaction between the classification systems and the IFC operating principles and how that's come up in your work?
Sure. I think that the ABCs have become a ubiquitous form of classifying what a manager does, and I think it's fair to say that they've become embedded in many other frameworks and standards. So Claudia had described, and you too, Cathy, the new SDG impact standards that have been created, where the infrastructure that the impact management project has built really provides the foundation for that SDG impact standard. It's very similar with the operating principles for impact management, which is a fairly inclusive standard and accommodates, again, different asset classes and approaches to having impact. And yet, increasingly, we're seeing that in the disclosure statements of signatories to the operating principles in the work that Bluemark is doing to verify alignment with the principles, that the ABCs, again, are becoming embedded within our understanding of what best practice means. And so it's more a case that ABC has become absolutely the universal framework, and the operating principles is one aspect of practice excellence and a standard that managers can obviously sign up to and aspire to, that embeds the ABCs as again, part of its foundational infrastructure.
Great, thank you for that. There's some questions here I will toss to the panel and see if anyone would like to answer, because I'm not sure who will know. How does this integrate with the EU taxonomy work on classifying sustainable funds? Does anyone have an opinion on that?
I have an opinion. I can only talk to our system, but I had this conversation frequently with practitioners, so I'll give it my best. So for the ones who don't know, the EU taxonomy will come into play March 2021 and talks a little bit about how you can label investment products and what type of disclosures will be applied. If you look at those, you will see that if we're coming back to the ABC kind of a way of looking at things, a lot of the disclosures that are requested there would actually only fall into the A bucket, because it looks at how you can mitigate negative outcomes. So that is one of the things to point out here. So it doesn't really help if you want to look at positive outcomes and how you're advancing the Sustainable Development Goals. So that's one thing I would say. Another thing I would say, obviously, we are well aware that EU taxonomy is a regulatory requirement for many of the people using our systems. So we've been looking at how we could potentially integrate it, and that potentially lets me also explain and add on to what Ben has just said about the operating principles and how the impact classification system works. Because what we're really trying to achieve is to provide clarity to investors and asset owners what people are doing while remaining agnostic. So there are many standards you can be adhering to, and there are many frameworks and measurement approaches you can apply. So by just creating a central repository and creating transparency about what people are doing, and then creating the common language and wrapper of the ABC categorization or the impact classes, I think that's really the benefit, and the same would apply with the EU taxonomy. So we will integrate it at the beginning as a simple checkbox, so you can indicate how and where you're adhering to the EU taxonomy, while also looking as to where we can capture further information.
Great, thank you. We have a question about, do you think that, what is the flexibility or adaptive nature of these frameworks as the world and our subsequent needs change over the next decade? In other words, will ABC be a temporary framework or a longer term framework? Will it outlast the SDGs by 2030? And I'd be interested in panelists' thoughts about that. Maybe too soon to know.
I can go if nobody wants, and I go first.
No, please go ahead.
So some of these discussions are very fresh in mind, and that's probably why I have an answer for them, because I have them quite frequently, right? And people are saying, like, you know, will the impact classification system go away once we have a standard like the IFRS accounting standard alike for non-financial reporting? And my view on things is no, because I think impact classes serve a different purpose. It is almost, and interestingly, Macron spoke today about, you know, there needs to be a better way to consume information about green finance. And he actually talked about something, an analogy I use about labeling and consumer choices. And I think, you know, while we have asset classes in finance, and they didn't go away, I mean, they don't go away just because you have the underlying granularity of data on financial metrics, I still feel that the impact classes will serve the same purpose, as that they will become a labeling system that allows you exactly what we talked about, you know, the improvement and engagement, seeing how assets move across the classes and monitor and track portfolios over time. And, you know, in the conversations I have with, you know, ultra high net worth investors, family offices and foundations, they don't want to look at this granular data, but they do want this label and this system of understanding how they're achieving their impact goals. And that, Cathy, is what you said. So I think they will continuously serve a purpose. And we are just in that kind of interim period where we're coming from a very immature to a more mature space, where people still struggle to wrap their head around it a little bit.
Mm-hmm. I'm running out of time for Q&A because we want to start with some summary comments, but I just wanted to say, I think that there's a lot of questions here around how do I actually classify? Can you give me an example? Can you walk through what are the trade-offs? You know, if I have an enterprise that has multiple impacts and some of them are positive and some of them are negative, and, you know, how do I do that? I just wanted to say, we know that the how is really important, right? That it's not a standard unless people can apply it consistently. And that's why we are developing examples, case studies, flow charts, right? We have a quick one-page flow chart that allows you to classify any outcome that's within your company. But the idea here is that you're not just classifying the company or the investment as a whole, you're classifying what it does towards different outcomes. And so everyone's going to have multiple classifications. And the idea is to then simplify that and kind of boil it up into overall, what is the label that most investors or most others would want to give to this investment, so that they can then put it against the other things that are trying to do the same thing, right? So that we can start to compare. And it looks like Ben wants to jump in.
Yeah, well, thanks, Cathy. I think that's a good segue to a final round of questions to wrap up the conversation. And I'm going to turn to Claudia first to build off of that, Cathy, because I think you've described one aspect of what else is needed beyond the tool that Claudia's created to classify, which is a set of great examples and case studies and transferring knowledge and the how-to for folks so that they can actually use the framework. Claudia, I was going to ask you, what else do you think is needed to realize your vision and our sense that classification really will be a focal point in 2021? Other than the use of the tool, what other market building aspects do you think are needed to support the effort?
Yeah, so Cathy has obviously touched on the obvious one, which is education. And you know, I think the questions we are seeing are reflected of that. So how do we do it? So I think education is a key part. And that leads to the second one, which is collaboration. And I think collaboration is needed on the macro level. So if you think about regulation, standard setting, so people coming together and really creating consensus around some of the disclosures and how to collect data going forward. And then on the micro level, of course, as well, you know, more infrastructure with regards to interoperability of platforms and data sharing. I think that's really, really crucial. So we are already partnering with a network of strategic partners who share our strategic objective of consistent impact classification. A few of them are on the call today. I'm delighted to see them there. So that ranges from academia to development networks to other technology platforms, because I think it's in the end really, really simple. So the more people use impact classification, the more valuable it will become, right? So it's actually very simple. And I think once we get to the point that we all use a common language, the more realistic will be an allocation for impact on portfolio level, actually.
Great, thank you, Claudia. Bhavika, once you've diligenced hundreds of funds using the impact scorecard, you'll have an incredible set of data. I mean, could you imagine benchmarks and other kinds of measures and tools emerging from that analysis? Where do you see that going? It's quite an exciting proposition.
Yeah, I mean, I think we hope so. I think we'll certainly have a view on what is best practice on, you know, within each of those 5 areas that we're scoring, and have a view on, you know, what are the top quartile impact managers on those areas doing versus what's less best in class. As to the question Cathy asked earlier, I think we would also hope and expect that the whole space will move towards the higher scoring within our scoring. And so there may be a point at which we need to actually strengthen our scoring or make it a little more rigorous as everybody moves to the higher end of our scoring. That's the hope, because we'll actually have more managers and more opportunities at the higher end. I think we're also hoping, and this is something we're thinking through as well, is how we think about at some point developing frameworks that link performance on the impact side with achieving their financial and commercial performance, and if there's correlations there that we can draw upon. So we're very excited about the data we're collecting. We're hoping it can lead to the benchmarks that you're describing.
Right, thanks, Bhavika. And Anna, we're going to give you the final word. You've been on this journey for a long time now, building Bank of America's leadership in sustainable impact investing. What ripple effects do you think more robust classification could have at a market level?
Yeah, I mean, I think just to sort of key off of what Claudia and Bhavika were saying, I think that as and what you were saying in your blog, right, as people move and get on the actual ABC grid, right, where they start at least avoiding, and then you know, I think that, you know, again, you know, the hope is that classifying it creates, as Bhavika said, a standard that sort of lifts everyone, right, and that you know, we don't believe that there's some, you know, magic proprietary element to sort of stating your sustainability objective and then being measured against that. It's what people do with their investment objective all day long, right? Like everyone measures your investment objective. Everyone measures an investment objective. And so I feel like I feel like if the sustainability objective, right, becomes as important in not just strategies that hold themselves out as sustainable, but in, you know, for the investment management universe in general, that's when you're starting to see real change. And that's what we're hoping to get to, right? So the whole purpose of this is to use a framework that we think is applicable very widely across all asset classes and is simplistic, but sort of obvious in sort of where you fit in classification wise. I mean, with some gray areas, of course. And then to really move towards not just the classification, but actually really being able to better pinpoint what your sustainability objective is and how you're reaching that. And by the way, whether success is not only your achieving your risk and return target, right, but actually also achieving your sustainability objective. And for us, that is, you know, where we want the capital markets to go.
Great. Well, thank you so much, Anna. Thank you, Bhavika. Thank you, Claudia, for your leadership in impact investing. And of course, thank you to my partner in crime, Cathy, for the work we've done together. And please look out for Cathy's curriculum, which will be coming soon. We'll send information about how to access the excellent work Cathy's doing in partnership with UNDP and the Impact Management Project. Please read our blog on Impact Alpha and visit Tideline.com. Thanks so much for joining us today for our inaugural Compass Series discussion.